In this video, we're going to discuss the common traits of people who will never retire. Coming up next on Holy Schmidt.
Holy Schmidt!
Retiring well is not just for the wealthy. In fact, the average person can retire extremely well if they apply a few basic rules. But frankly, many, maybe even most people miss most of these rules, and because of that, they find themselves struggling in retirement when they could be living a life of leisure. Let me ask you if this sounds like somebody you know, maybe even you know personally. When asked how much they have in term life insurance at their office, at their work, they have no idea. When asked how much they pay in property tax, they don't know that either because it's all part of their monthly mortgage payment. And frankly, when you ask if their 401k went up or down last year and by how much, they have no idea there either. The fact is, for most people, they can't control any of those points. But not knowing the answer to any of those questions is a sign of something much bigger, a much bigger problem, frankly. They're missing something called personal financial acumen. That's a fancy term which just basically means that they don't know the basics of their finances. It all works somehow, so it doesn't really matter, at least for now. This is an extremely dangerous mindset because, frankly, these people are often the target of a financial scam. They spend on things that are unimportant and not on the things that are important, and they don't set themselves up so that they have a wonderful retirement because no one has explained just a few basic rules. What are those points to consider? First, they have an unhealthy relationship with debt. They keep credit card debt because who cares? It's only about $150 a month, and I make a lot of money, so what's the point of paying down, say, $10,000? That will be a big hit, and for $150 a month, that's just the cost of doing business, so to speak. I've often thought of credit card debt, particularly for the people who can afford to pay off their credit card but just choose not to do it, as the high blood pressure of debt. You don't know it's a problem until it's too late. Then it's a killer. There isn't a person watching this video who hasn't read a credit card statement that said you had a balance of, say, $10,000. It doesn't really matter what the balance is. It's the concept, but let's use $10,000. You have a balance of, say, $10,000, and if you pay the minimum, it will take 28.5 years to pay off. And that data, by the way, is a typical credit card at 18%, where the credit card company charges you the interest that you owe plus 1%. The payment would be $151 a month for 28.5 years. When they see that on their credit card statement, they actually don't read it. They see it, but they don't read it. It's invisible to them. They make the minimum $151 payment because that's super easy, and 28.5 years later, they've paid over $41,000 in interest expense on a $10,000 credit card balance. Now, what if this same person who can afford to pay big chunks on their credit card pay $200 a month instead of $151? Well, they would pay $8,622 in interest, and they'd pay it off in about 7 3/4 years. If they paid $250 a month, so $99 more per month than the minimum, they'd have it paid off in about 5 years, and they'd pay $5,386 in interest. Do you think that they'd really notice the difference, the $99 difference, on their overall cash flow? So in about a third of the cases, people who have the money to pay off their credit card rapidly make the minimum payment because that's just the cost of keeping that extra cash flow free for other things. But time does march on, and when someone has a lot of cash flow in the beginning, middle, and maybe even late years of their career, that all changes as they approach retirement. There's a really good chance that that person doesn't fully realize that it's not about the $99, it's about the $36,232 of extra investable money, which could be 6 figures by the time they retire. And because of that, that person may never retire. Now, if you need a new car and you're in your late 50s or 60s and you finance it, there's a really good chance that you will be taking that car payment into retirement. And you see a lot of people who watch this channel who just pay cash for their car. Sometimes they buy it new. Sometimes they buy it a year or two older because they can get a great deal on a slightly used automobile. The second person will be going into retirement without automobile debt. The first person will be making that payment into retirement. The next point, and this one's extremely polarizing, that's taking a mortgage with you into retirement. Now, if you were to ask Jeff Schmidt of 2024 whether you should take a 3% mortgage into retirement or not, my answer would be no. If you were to ask Jeff Schmidt in 2019 if you should take a mortgage into retirement, I would say it depends. If you had a low interest rate, like say 3%, you could achieve, say, a 5% yield on a safe investment, and it's part of a diversified portfolio. It's something to strongly consider, leaving the mortgage in place. The argument that having a mortgage rate at 3% outstanding, if you can invest at 5%, basically the return on a savings account today, frankly, is a compelling one, and it makes a lot of sense financially. But here's why you still shouldn't do it. Retirement is both a financial game and a mental game. And the mental game is relieving your body and your mind from a lifetime worth of stress. Freedom from the obligations of having to raise a family, freedom from the heavy debt burden of a mortgage. Frankly, you've earned the right to have the mental freedom in retirement. If you get nothing else out of retirement, freedom should be job one, because you've earned it. Next is not knowing, as you approach retirement, how to get the best possible price on the things that you regularly buy, and frankly, the big things as well. Let me explain. First, getting the best possible price, there are a lot of ways to do it. If you were to ask Jeff Schmidt of 2019 how to get the best possible price, I would say get professionally trained in negotiation. In fact, for full transparency, I attended the Harvard Business School strategic negotiations class, and it was a game changer for me both professionally and personally. To this day, I still think deeply about something called a zero-sum game. And basically, in a negotiation, when someone gets more, the other person gets less, and vice versa. Let me tell you a very quick and highly impactful story that talks about the importance of learning how to negotiate, because it actually happened to me. In the early part of the 2010s, we were selling our old house and upgrading because we had a bigger family, and we put our house on the market, or at least we were about to put our house on the market. It was April, and our neighbor came by and said, "We heard you're selling your house. What's the price?" We told them we're going to list it for, in this case, let's say $100 because it's a nice round number. Obviously, add a few more zeros, but let's say it was $100. They said, "We have our brother who wants to move into the neighborhood, and that would be the perfect house for him. We'll offer you $85. Now I said, "Thank you, it's $100. They said, "Well, he can't afford $100. My response was, "Well, maybe this isn't the house for him." We put our house on the market, and we got the first offer, and instead of $85, it was $92, so 92% of asking. We said thanks, but no thanks. Our real estate agent thought that she could get at least 95%, if not more, and lo and behold, the next offer was 95%. And then the one after that was 96%, but it had some conditions. Finally, we had another one that we were prepared to say yes to. It was at 96% of the asking price. It had the typical closing conditions of qualification for a mortgage and home inspection. The next day, we ran into our neighbor again and told them that we were about ready to accept an offer on the house, but as a courtesy, we wanted to let them know because they were our neighbor, and it was at 96%, to which the neighbor said, "We'll offer you 95%. I said 95% isn't 96%, and they said the one thing that was the game changer, and that was we will make the transaction hassle-free, meaning we won't bring up a lot of small issues. I said, "What does that mean?" Specifically, cash offer. The inspection is simply because we want to make sure that there's nothing foundationally wrong, but we won't nitpick on tiny little issues. And so we said, "Well, that sounds great." Talked to my wife, and we had a discussion, and we said, "Yes, we accept." And as was listed in the listing, there was a small problem with the septic, which we'll take care of before closing. They said, "Absolutely fine." We sent them the paperwork, and we said, "Okay, we're ready to go." And they said, "Well, we just want to take a quick inspection of the house." I said, "Fine, no problem." They brought somebody over, and they started listing all of the issues that they found wrong, that were nitpicky issues, simply not hassle-free. And they said, "And by the way, you have this septic tank issue that you said you were going to fix. We want you to put $25,000 into escrow to deal with that issue. I said, that's not hassle-free, and frankly, that's not something we're going to do. They had the contract, and I said to our real estate agent, continue to show the house just in case. Fast forward, we continue to show the house. A couple comes by at the end of June. It's almost the 4th of July weekend, and we're getting ready to go away, and they make an offer for 100%. Now we have a situation. We've got our neighbor who has effectively reneged on the hassle-free aspect of buying our house for their brother, and we have this new offer. So I said to the broker, send them in on Friday to do their inspection, remind them of this septic tank issue, which we'll pay for. It'll be about $2,000. And then if they want to move forward, let me know. She said yes. They still said yes. They did the tour, and they were good to go. The Friday before the 4th of July, I sent an email asking my neighbor to drop all points immediately because we would not accept them. To which they came back and said, we're raising the deposit from $25,000 to $125,000 for the septic. I called up our lawyer and I said, send a second contract to the other couple. She said, do you want me to rescind the contract with the first couple? I said, no, leave them both outstanding. And she said, I'm not sure I can do that. I said, until we sign the contract, it's not an agreement. So she did. The other couple on the Monday signed the contract, put the deposit down, and I said to the real estate agent, take the for sale sign down out front. We're going away for the week for 4th of July. We came back. There were something like 22 messages on our home voicemail. It was the neighbor. They wanted to know what the status was. And we, of course, explained that we have rejected their offer. Learning to negotiate means that we made more money, we created other options, and the transaction was indeed hassle-free. Not hassle-free from our neighbor, but hassle-free. Fortunately, in retirement, you don't have to take a Harvard Business School negotiations class. You're not faced with life or death negotiations, staring across the table at, say, a union boss negotiating a multi-billion-dollar agreement. The biggest things that you're negotiating are your house and your car in most cases. However, you do have a lot of day-to-day purchases which are supremely important to get right, and the person who can get those right can afford to retire. Most of the time, though, it's not staring across the table in a strategic negotiation. It's just getting one of three things right. Either comparative pricing, buying a substitute that is equally as good, or buying at a different point in the season where things are less expensive. Let me explain. Comparative pricing is generally the biggest game changer for folks because stores don't agree on price. In fact, it's illegal. It's called collusion. So instead, they compete on price, which means that the product that you buy at one store is probably going to be less expensive at another store and even another store. That's really bad for them, but really good for you. So let's say you're a consumer of organic fruit and you know your three stores are Stop and Shop, Trader Joe's, and Key Foods. You just simply compare the prices at those three places. Substitution, on the other hand, means instead of buying organic strawberries, you buy regular strawberries, and that's good enough because the organic strawberries are expensive everywhere. And buying seasonally means that you buy strawberries when they're in season and very inexpensive, and when they're not, maybe you buy blueberries because those are in season. And you start switching from one to the other depending on which one is offering the lowest price. Next, a common trait of someone who will never retire is that they don't have a budget and they don't even know where to begin when it comes to a budget. If I asked you the question, how much are you going to spend this month? If you're like 2/3 of the people responding, you won't get it right within 15%. I'm not talking about getting it right within $100. I'm talking about 15% of your total spend. 2/3 of the people do not have a budget and they can't answer that question. So having a budget is extremely important in retirement. It allows you to direct your cash flow where it belongs and nowhere else. So remember that retirement is long, hopefully, and because of that, learning how to budget is supremely important. Frankly, those that get it right will enjoy a very fruitful retirement. Those that get it wrong, unless they're just so wealthy it doesn't matter, will struggle a bit more. My guess is if you're watching this video right now, you're working on getting it right. If you like this video, check out that video on where retirees spend 80% of their retirement income. This is Jeff Schmidt. Thanks for watching.